So guys, today we are going to talk about a very interesting topic in the world of stock market, and it is called hedging. Okay, so if you want to become a serious investor or if you want to become an active trader, then you have to pay attention to this video because it will save you a lot of money. So let's start with the basic question that what exactly is hedging? So think of hedging as insurance, right? So we buy insurance to protect something that we consider to be valuable, right? So we buy life insurance, we buy car insurance, we buy health insurance because we want to protect ourselves from a loss of something that is important to us. Now, exactly the same concept is applicable in the world of stock market. The only difference is that what we are trying to protect here is not life or car or health, rather a very valuable investment, right? So those of you who were invested in the stock market before the COVID crisis and went through the whole COVID drama must have seen your portfolio drop by 30%, 40% and 50%, and at that time you must have felt if there was any way which could have prevented that loss from getting bigger and bigger. Well, hedging is the answer, right? So hedging is a way to protect your portfolio from a big loss. So now that we understand the basic concept of hedging as an insurance, the next thing that we need to understand is that hedging is done through an instrument called derivatives. So if you are serious about hedging, then you need to develop a deep understanding of these instruments, because only then you will be able to pick the right product, the right instrument to protect your portfolio. Now let me take some real life examples to make this thing a little clearer, right? So let's say you have bought a lot of shares of a certain company, let's say Reliance, and you are a little worried that okay, if something bad happens to the company or if something bad happens to the promoter of the company, then the stock can fall down significantly, right? So we have seen something like this happening with the whole Adani crisis. So what you can do is that you can sell a future of that company. So what will happen, let's say something bad like that materializes, then the value of the investment will go down, of course, but the value of the hedge, the short position that you have created in the future segment, will go higher. So this hedge will basically protect your portfolio from incurring a big loss. Now another way of achieving the same thing is through options, right? So instead of selling a future, what you can also do is you can buy a put option, right? So same situation, the stock goes down, the value of the put option will go higher, thereby giving you some kind of a relief from your big losses. So that is a scenario where you hold an individual stock. But what about when you hold a very well diversified portfolio across different sectors? You have pharma, you have FMCG, you have metals, you have banks, you have IT, right? So in those cases, mature investors use Nifty for hedging purpose, right? So exactly the same way, if you have a balanced portfolio, what you do is that you sell a Nifty future and the market comes down, the value of portfolio is coming down, the value of this Nifty future is going higher. And alternatively, you can also buy a put option of Nifty, in which case the investment goes down, the value of the put option will go higher, thereby giving you the right coverage.
Now let me tell you guys 5 basic principles of hedging.
Number 1, the value of investment that you are trying to protect should be higher than the premium that you are paying for hedging. Okay. So for example, if let's say you are insuring your car, the car is worth let's say 10 lakh rupees, then you will not be paying a premium of 15 lakh rupees to protect a car which is worth only 10 lakh rupees. It doesn't make any sense, right? Now, however logical this may sound, in reality, especially in trading, people pick wrong instruments where the value of investment that they are protecting is actually lower than the premium that they are actually paying for protection. Number 2, the direction of the hedge should be opposite to the direction of the investment. In other words, if the investment value is coming down, the value of the hedge should go up, and vice versa. If the value of investment is going higher, the value of the hedge is coming down. Means both are negatively correlated. Again, a very simple concept, but people again make some very basic mistakes in doing hedging because they pick a hedge which is not exactly negatively correlated with their investment. So when their investment value is coming down, the hedges are not really going up in the same proportion. Third thing, and a very practical thing to keep in mind, is that hedges cost money, right? So every time we think about insurance, we always have to also think about the premium that we are willing to pay for the coverage. So if the premium is very high, sometimes the insurance may not really be worth it, right? In the same case, the investment that you are trying to protect should be worth enough that you are willing to spend money for hedging purpose. Number 4, a very important thing, that hedges can only partially compensate for your losses from the core investment, right? So don't expect your hedges to fully compensate for the losses that you are incurring in your core investment, because if you design your hedges in such a way that you want to compensate for all the losses, then the premium that you will pay for that kind of a hedge will be significantly higher, and that over a period of time will not make sense. Number 5, last but not the least, hedges are not permanent, right? So just like when you take a medical insurance for a year, after the year is over, you have to renew the insurance for the next year. In the same way, as we saw in the case of Reliance and Nifty, we hedge through futures and options, and futures and options, they have an expiry day. That expiry can be several weeks from now or maybe several months from now. But once they expire, we again will have to buy new hedges to cover ourselves in the subsequent future. So guys, these were the very basic concepts of hedging. I just wanted to give you guys a high level overview so that at least you will understand what hedging is all about. Now hedging can be a little bit more complicated when it comes to trading, right? Because long term investments are fine, trading have several different dimensions that we need to consider. So we'll make different videos talking about hedging, how do we hedge in futures positions and option positions, and through different strategies. But I hope at least this video would have given you a stepping stone in the world of hedging.